Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Asian equities climb after stocks, bonds and commodities all rally in the U.S. as the Fed cuts interest rates. Donald Trump names Susie Wiles his White House chief of staff as the world waits to see who the president-elect may tap to drive his economic agenda. And Ghana's opposition leader tells us why he would renegotiate the country's IMF program if he wins the upcoming elections. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Versace in Dubai. TGIF, we have got to the end of this very long week. U.S. elections, the Fed interest rate decision, and for me, ADIPEC earlier in the week as well. So it's been quite a long week. But let's just center in on what we got out of the Fed yesterday. They did cut interest rates in line with the expectations. And not a surprise, but the Fed chair did field a lot of questions about what an incoming Trump administration means for the Fed's path forwards. We're going to talk more about that on the show. But essentially, he sort of kept the door open or shut for another cut in December. What that meant is yet another positive session for equities, Wall Street, ending at another record high, S&P and NASDAQ all-time record highs. Today, futures not doing that much, but again, building on that positive momentum for the week. 10-year yields also in focus, but this is what the market is pricing in for next year. And you can see that markets have really pared back their expectations of interest rate cuts for 2025. Not so long ago, the market was pricing in almost another 160 basis points of cuts throughout 2025 calendar year. Now we're sitting at about 78 basis points cumulative, so slightly more than 3 interest rate cuts. It just tells you a lot about how much bond yields have been moving, but also how the market has been factoring in and accounting in for the possibility of higher inflation, possibly higher growth as well. But let's also check in on how markets in Asia are faring this morning. Avril is in our Singapore studio. Avril, so much news to digest, and it's not just the Fed and U.S. elections, but also there's a lot of focus on the China NPC, the Standing Committee meeting, and expectations of that potential fiscal boost coming up.
Sure, Jumana. So we're seeing across Asia today that the Chinese stocks are the ones that are underperforming. And when you look at the region's gauge, it's actually pulled back from some of these session highs. Even though the rest of the region is looking fairly positive, we're also seeing bonds and currencies that are recouping some of the declines from earlier in the week. And this is partially to do with the Fed cutting rates, Powell talking about the strength of the U.S. economy. But you also get the sense that there is a bit of a recalibration about the initial fears about what Trump's tariffs would mean for inflation. So this is the picture across the board. Chinese stocks are underperforming, and to your point about the NPC is really going to be about them filling in the blanks, coming through with that fiscal boost, whether it is addressing some of the issues about housing support or local government debt. Jumana.
Avril? Thank you so much. That was Avril Hong in Singapore. Well, back to our other top story overnight. The Fed has cut its benchmark rate by 0.25 percentage points in a unanimous decision, and no real surprise to the market. The chair, Jay Powell, declined to say whether they will cut rates again in December. He also says the election outcome will not affect what policymakers do in the near term.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Bit of a tricky position for the Fed chair to be in there. Bloomberg's MLive strategist Mark Cranfield joins us now. Well, we just played some tape of how many questions the Fed chair had to field about the prospect of an incoming Trump administration. Before we talk about that, let's just talk about the interest rate decision itself. They cut 25 basis points and seems to have sort of kept the door open to potentially not cutting in December. So we saw that market reaction right afterwards.
Yeah, exactly. And that's what traders are looking for here. Now that the decision is out the way, we're going to get Fed speakers coming back, and lots of them as from this weekend. There'll be for many days ahead. You'll be hearing opinions. And we knew going into this FOMC that there's quite a division between what the opinions of different people. There's no central opinion here. Even though they all voted for a rate cut there, you can tell from their nuances that they don't all agree on the path ahead. And we're likely to hear more about that in the coming days. One of the big things that traders are going to be looking for here is, does the emphasis shift back towards the inflation data? They're obviously going to say they're data dependent, but which data? Because recently it's been more skewed towards the employment rate, but we could shift back towards inflation data as they were earlier in the year. If we hear a subtle shift, more people talking about CPI data, more saying, where is inflation going? That is probably a clue that they are concerned about the potential for the kind of new policies that may come in next year and increase the fiscal deficit and boost the economy, which could mean more borrowing at the long end of the Treasury curve and generally lift inflation. The Fed are very smart. They're not going to be explicitly telling you that they disagree or they're worried about new policies, which they haven't obviously seen. They won't speculate about that. But they could show their concerns through talking more about inflation.
Yeah. Let's go back to the comments that he made in the press conference vis-a-vis what he would do should President-elect Trump try to remove him. He was pretty adamant that he's not going anywhere, at least not willingly. Is there anyone in the market who is beginning to think that perhaps the Fed chair may not be in his seat in the coming years? Is that a risk for markets in the years ahead?
There's no indication at all that financial markets are pricing in a premium or a discount, whatever you prefer to say, for the risk of a change in the Fed chair. The most likely place you would see it would either be in the Treasury curve or in the US dollar itself. People quite often use the currency as a kind of a vote on what they feel about the policy situation in any particular country. So if they were concerned that there'll be a sudden change in the leadership of the Federal Reserve and maybe the risk that somebody completely unknown would be coming in, you would expect a much weaker US dollar than we currently have. We are not seeing any indication at all in the financial markets that people see that as a serious possibility. So that's where we would really be looking for, is increased foreign exchange volatility, possibly even a sudden steepening in the US yield curve. It has been, but at a relatively modest pace so far. Those are the kind of indicators that we might get. None of that has been happening so far.
Yeah, valid point. Well, let's just see how this all develops. But early days, it will, if anything kicks off, it will happen in the beginning of 2025 once President Trump actually does take the seat. Bloomberg's MLife strategist Mark Cranfield, thank you. Well, Gulf central banks, including Saudi Arabia, the United Arab Emirates, and Qatar, have followed the Federal Reserve's decision to cut interest rates. The rate cuts were made to maintain the peg to the US dollar despite muted inflation in the region. So they all cut by 25 basis points. Now, Republicans remain on track to win total control of the U.S. government, regaining not just the White House, but also the Senate, while retaining control of the House. Meanwhile, Trump's new administration is taking shape, the president-elect naming Susie Wiles as his White House chief of staff. She's one of the top architects behind his landslide presidential victory. So for more, Bloomberg's Vonnie Quinn joins us from New York. Vonnie, what do we know about the team that's shaping up, who Trump is eyeing for some of these key cabinet positions?
Yeah, it's a definitely different transition period this time from the first time around. That's largely to be credited to Susie Wiles, whom you just saw in the pictures there. He calls her the Ice Maiden, and she has definitely been holding him on message. She was his campaign manager, and she is now the first female chief of staff ever to hit Washington. In terms of economic roles, because even though it's only 2 days post-election, plenty of names are being bandied about. We have the likes of hedge fund manager Scott Bessent, who could help craft economic policy. He did already help craft economic policy speeches during the campaign. There's also the likes of former SEC chair Jay Clayton, Robert Lighthizer, a name that's well known because he was the trade representative during Trump's first term. He was a China hawk, though, and so investors may be a little bit concerned were he to be nominated for Treasury Secretary. He could be maybe perhaps nominated for Commerce Secretary or something else instead. And of course, we know the names of Elon Musk as well, and Howard Lutnick, who was also part of the campaign team. They could potentially serve as what's called a special government employee, so they wouldn't be paid, but they could work up to 130 days in an administration.
I'm recalling the description of Robert Lighthizer back in the day. I think he was known as the trade czar. So a return to that really perhaps signals a lot about what the administration is planning on doing vis-a-vis trade and these tariffs. But speaking of, it's interesting to see that already, it's not just stock markets reacting, but we're actually beginning to see companies preparing on the ground for the potential of these tariffs hitting next year. So what are some of the economic implications that we're seeing already?
We're definitely getting lots of rhetoric, lots of comments, and you know these companies have been in preparation mode for some time, right? Since Trump was the, presumptive nominee for the GOP, they know that he has a policy of 60% tariffs on China, at least as a starting position. And so some of these companies have been out making the rounds. For example, Steve Madden, the shoemaker, talking about how they're planning to shift production out of China by 40% now. That was only 10% a year ago, and they have moved that target up. They want 40% out of China. It also is affecting consumer goods companies. So Whirlpool, for example, saying if you want to buy a microwave, it's going to be a lot more expensive as an American consumer. Those are the types of electronic devices that are mostly made in China for Whirlpool. And then one you mightn't consider, Jumana, but it makes a lot of sense when you think about it, cat litter that needs silica gel. Well, apparently China is the only place that you can source silica gel. So if you are a cat woman or a cat gentleman and you want your cat to have litter, you might have to pay a lot more if those tariffs do indeed go ahead.
Yeah, so interesting that companies have been so quick to act already. Bloomberg's Wani Quinn in New York, thank you so much. Now, still ahead, we'll get the market outlook with Emirates NBD as investors shift their focus from the Fed to China. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Asian stocks are extending Wall Street's rally today after the Fed cut interest rates. Investors now shifting focus to China, which is set to unveil a fiscal package worth trillions of yuan that may potentially offset the impact of potential trade tariffs under Donald Trump. So much going on this week. Let's bring in Maurice Gravier, the Wealth Management CIO at Emirates NBD. Good to have you with us. It's been quite a big week for financial markets.
It was.
Let's just start with the Fed decision. They cut interest rates by 25 basis points. No surprise there. But I think what was a surprise to the market is it's unclear what they're going to do in December. He's actually hinting that they may not go for another cut this year.
Yeah, for sure. To some extent, the Fed is following market expectations, and you have seen that the Fed fund future have turned quite aggressively. The 25 basis points cut was widely expected, including by us. We still expect another cut in December, but the thing is that the U.S. economy is still super strong. You've seen the ISM service is 56. I mean, it's serious, and disinflation has a bit stalled. So I think it's only fair to not to guide too much. I'd love to see the Fed doing a bit, the Swiss National Bank way, talk a bit less and be a bit more systematic, like one cut per quarter or something like that.
Well, they only meet 4 times a year, the SNB, so they're in that privileged position versus the Fed. But I take your point on that. What do you think about the market's expectations of interest rate cuts for next year? Because we've really moved up a lot in terms of pricing. A lot of those rate cuts have been taken out. At the top of the show, I was just saying that there are only 3 rate cuts priced in for all of the calendar year now in 2025. Do you agree with what's priced in? Is that too little now? Are we erring too much on the side of caution?
I think it's a bit too little, but not that much. I mean, there are 2 things. First, the structural trend of inflation, whatever happens in terms of policy. I think that we're in a world of higher inflation than before, let's say, and I think the bulk of this inflation is behind us. Then there is the Trump effect. And of course, if you look at tariffs, immigration, whatever, this could be inflationary. But I think that Mr. Trump will be very cautious with inflation. So we have 5 cuts currently in our base case for next year, and 1 more in December, and then 5. Maybe it's 4. 3 looks a bit aggressive to me.
Yeah, you said something really interesting that I want to pick up on there, and that President Trump will be very cautious with inflation. He knows that potentially one of the big reasons why they were elected, why he was elected, is because high inflation levels cost the Democrats the election. It was the economy at the end of the day that was the most cited topic on these exit polls. Therefore, it perhaps then precludes the possibility of him going too harsh on tariffs if he thinks it's going to be too high of an inflationary impact. So maybe the market is getting ahead of themselves in terms of expectations.
I couldn't agree more. The single economic factor which explained that the Democrats lost is inflation. That's absolutely zeroed out. I mean, growth was very robust, employment was full. It's all about inflation, and I think that Mr. Trump knows that. And from a platform to policies, we don't believe at all in this 60% tariff on China. It is just impossible for the U.S. consumer that buys lots of stuff from China. That's how the world is. It won't happen. And same for some other aspect. I think it will be very careful in inflation. That's why we're not too worried.
Yeah. Where are you seeing opportunities now in the market? How are you looking to invest, given we now have this new paradigm, and the paradigm is Trump 2.0?
Yes, definitely an indirect line with what we were just saying. Longer duration bonds could become interesting again, because if we start to price in something, some inflationary impact that could finally not happen, when the 10-year is around 4.5%, it's becoming very tempting. We are overweight bonds. We had cut duration precisely because we didn't really know. When we see these levels, it's becoming to be interesting. And looking forward, next year is probably be about more rotation and selection than direction, we believe, at this stage.
Yeah, that's also interesting, because I was going to ask you about stock market direction. Again, even going into these elections, stock markets were at record highs. Countless times this year I've come in the morning and it's been another record high for S&P and Nasdaq. Now it feels like it's got another turbocharge because of expectations of deregulation, tax cuts, fiscal boost to the economy. What is going to derail the stock market trajectory from here? What stops these markets from going up?
At some point it's a matter of valuation, and you always value on the future trend of earnings. And even on the macro side, I don't know how long the US can grow above potential. Yes, there is a boost. Mr. Trump's policy is pro-domestic growth and pro-profits with tax cuts in particular, deregulation. Now stocks are not cheap in absolute, US stocks, and relative to bonds, again, in terms of risk premium, bonds look a bit more interesting. And then we'll have to look at what happens in the rest of the world. Europe is probably in trouble, but the emerging markets, developing their own market within the BRICS is something to look at.
Let me just round up the discussion asking you what you think the return of Trump means for this part of the world and his policies, his economic policies. This is an economic question, not a geopolitical question. Is it going to have any ramifications here?
I think that first, our region is not in the, let's say, in the crosshair of the trade tariff. There's no reason, and especially because the UAE imports more from the US than it exports in particular. And I think that Mr. Trump wants to rely on our countries. I know your question is not geopolitical, but still we had the Abraham Accord. He wants to restore peace in the region, and I think that the UAE and KSA are very important partners. So I don't think there is any negative impact. The strength of the dollar, of course, means the strength of our local currency, which are pegged. That's the key impact I see. For the rest, I don't see any particular trouble.
Fair enough. Maurice, we'll leave it there. Thank you so much. Maurice Gravier, Wealth Management CIO at Emirates NBD. Well, coming up, bracing for fresh tariffs, Trump's return firmly in focus as Chinese policymakers debate a massive fiscal package. We are live in Shanghai next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Chinese lawmakers are expected to approve a massive fiscal package when a week-long legislative meeting wraps in Beijing today. The measures may go far beyond the steps already outlined in Beijing as fresh tariffs loom with the return of Donald Trump. Our chief North Asia correspondent, Stephen Engel, is in Shanghai. Stephen, it feels like this whole week has been a bit of a crescendo because it's been a 5-day meeting, and we know that the big policy package is coming at the end of it. So what's in store? What can we expect out of this stimulus package that is going to be unveiled later today?
Yeah, what a week with the U.S. election as well as the Fed decision, and then now this big decision that a lot of investors are, of course, been waiting for as the previous stimulus package in late September started losing a little bit of steam, and a lot of people were circling the calendar on this National People's Congress Standing Committee, which was convened in Beijing on Monday, wraps up today. We're expecting any time right now the announcement on what exactly that next stimulus package will contain. Of course, the NPC Standing Committee, the NPC is the legislature. They have to, by law, approve any extra spending. So that's what we're trying to decipher, whether it's going to be a massive package or is it going to be spread out over multiple years? Is it going to wait even for a couple more party meetings that are going to be held next month to kind of gauge just how real are these potential Trump tariffs that you talked about with your previous guest?
Yeah.
Of course, he's threatened 60% across the board tariffs. but it could be negotiated down. So clearly they are weighing that, and they're going to be voting on that stimulus package.
Yeah, the word negotiation, I think, is going to come up a lot, the art of the deal next year. But Stephen, to your point about what may or may not happen, is there also a view out there that China are going to want to keep a little bit of firepower, a little bit of ammunition in the toolkit just in case they do have to go bigger in 2025 or 2026? They're not going to unveil a bazooka now because they need to keep a little bit in the kitty in case the tariff situation does get worse, right?
You would think, right? You wouldn't think that they would do it all at once. But again, the market expectations are for a pretty big bang stimulus package. So you run the risk, if you keep kicking the can down the road again, that there could be a little bit of fatigue. Look at the what's happened in the stock market. And I know Avril has been talking about that. The CSI 300 is up 6.5% this week alone, even though we had that turmoil of the election of Donald Trump. It's taking a pause right now, like we all are, just waiting for what those numbers are. But absolutely, they could stagger it out over multiple years. They could wait, as I said, for the impact or the reality of the tariffs from Trump. Clearly, he's going to have tariff action. Just how deep is that going to run? And is it going to include as well other countries? Because keep in mind, a lot of China's strategy has been to find diversified markets, third countries, and then they re-export into the United States, getting around those loopholes of the Trump era first tariffs. Now the Trump administration, incoming one, could potentially close off those loopholes by imposing tariffs worldwide.
Yeah. Stephen, I'm going to leave it there. Thank you very much. And obviously, we will be keeping a close eye on what comes out of that standing committee later today. So much for them to grapple with domestically and now also with some of those external pressures coming through with the return of Trump 2.0. Stephen Engel, our chief North Asia correspondent in Shanghai. Well, let's just have a bit of a recap of some of the market action that we've seen in the last few days. This is how futures are shaping up going into the European session. So it looks as though they're trading sideways, but of course, S&P, key psychological level, 6,000, all-time record high for Wall Street yesterday. Nasdaq 100, also another all-time record high. This as the market starts to account for an easier situation for corporates and perhaps further tax cuts and even deregulation. So all of those factors have been driving the performance this week. We're going to talk more, though, about some of the geopolitical impact when we come back, in addition to developments in Ghana, where the opposition leader is talking about renegotiating the country's IMF program if he wins the elections. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Asian equities climb after stocks, bonds, and commodities all rally in the U.S. as the Fed cuts interest rates. Donald Trump names Susie Wiles as his White House chief of staff as the world waits to see who the president-elect may tap to drive his economic agenda. And Turkey's central bank will unveil new inflation forecasts today as its 50% annual price rises fails to slow as quickly as hoped. It's just gone 8:30 a.m. across the Emirates. I'm Jemana Versace in Dubai, coming off that Fed central bank meeting. It happened on a Thursday this week, obviously, due to the timing of the U.S. elections. They did cut rates by 25 basis points, but really didn't suggest that another rate cut was coming imminently in December. And on the back of that, we did see a bit of a backup in yields. Markets pricing in only around 3 basis points, rate cuts throughout the course of 2025. What we did see, though, was a strong end for Wall Street, S&P, Nasdaq, all-time highs. Today, futures not doing that much. 10-year yield sitting at 4.33, so we did rally about 10, 11 basis points after the decision came through. This, again, as the Fed expressed some cautiousness, but also given how much of a run-up in yields we've had this week. Some people are saying, like our guest earlier on the show, Maurice Gravier from Emirates Wealth, that it may be time to start looking at buying duration. So we are seeing some support levels come through around 4.4 in 10-year yields. Brent also in focus today, dipping a little bit, down 0.6%, but still on course for gains of about 3% on the week. Remember, we kicked the week off talking about that OPEC Plus decision to delay putting back extra barrels to the market by a month. Also, geopolitical concerns stands squarely in focus as well. So sitting around 75 now. And then the pound, also talking about that, we've dipped a little bit today, but the reaction after the Bank of England cut rates yesterday by 25 basis points was for the pound to strengthen by 1%. Why? Because, again, the governor was very cautious about commentary vis-a-vis further interest rate cuts next year. The market has also started to price out interest rate cuts in the Bank of England rate cut path as well. Flipping over, I mentioned this at the top, but this just shows you that in the U.S., we've had quite a big move in the last few weeks. Early September, the market had priced in more than 160 basis points of cuts throughout the course of 2025. It's now only 78, so only 3 cuts priced in for next year. All right, let's move on and take a look at how markets in Asia are faring as well. Avril is in our Singapore studio. Just give us an overview of how some of these Asian markets are reacting to everything that has happened this week.
Yeah, Jumana, I think partially what we're seeing on the Asia stock gauge, how it's pulled away from session highs, indicates part of the caution surrounding the Fed's path, particularly if you look at what Trump's tariffs potentially might mean for it, and certainly what that would mean for the Chinese economy. And the CSI 300 is declining in the morning session, but you also get the sense that traders are really betting on a big boost from the country's NPC, and whether we see any support for the housing market, whether there's some help for local governments to ease their debt burdens. CSI 300, despite the declines of today, headed for its best week in about a month, and there's trading volumes behind this. It's also managed to retain most of the gains from that late September move, that monetary stimulus blitz. So this is what we're seeing, not just in Asia, but China in particular. Jumana.
Avril, thank you so much. Now, Ghana's main opposition leader says he would renegotiate an IMF program to reduce taxes and smooth loan repayments if he wins next month's elections. John Mahama, former president and leader of the National Democratic Congress, told Bloomberg he is the favorite to win the December 7 poll.
We're not party to the debt renegotiation, and we're also not party to the IMF program. But happily, we've had the opportunity, on my request, to meet the country director of the IMF, and he's briefed us, quite largely on a lot of what the 2 agreements entail, the IMF one and the debt agreements. We've not yet seen the final details of the debt with the commercial creditors, but we've looked at some of them, and we've done our own analysis of how the repayment schedule is supposed to be. We're supposed to end at about 55 to 58% by 2028.
Yes.
But if you look at it in our own analysis, if you draw the graph, we have 2 major humps. One in 2026, where a big chunk of the domestic debt is supposed to be paid. I think it's about 182 billion cedis. Mm-hmm. And if you consider that Ghana's total budget is just above 200 billion, then it means that there's going to be a hump there, and we need to see how to deal with it. Mm-hmm. Then the next hump is just before 2028, where there's a big payment in terms of commercial debt.
Right.
And so we need to look at how we can refinance some of this so that we can smoothen out the trajectory of the debt repayments.
Right.
And so those are things we would want to engage the IMF very early when we win, to engage them very early to see how we can work together, to make sure that we're able to maintain debt sustainability. We want to reintroduce the sinking fund, and we want to work on increasing our energy, oil and gas production. Over the last 8 years, Ghana has not been a very friendly environment to upstream producers, and so we'll try and get as many of them to come back as possible and give them the incentives that are required for them to ramp up in terms of gas and oil production.
Fascinating interview there. Let's bring in Bloomberg's chief Africa correspondent, Jennifer Zabazaja, in Johannesburg. It's pretty interesting that he's saying he wants to rework the terms of those IMF deals, the IMF program, rather. Ghana entered into the program in 2023, and obviously on the back of that, they were forced to take certain measures, including hiking taxes. But he seems to think that that is not the correct remedy for the Ghanaian economy. So how should we read his comments?
Yeah, Jumana, I mean, it is fascinating that we're hearing Mahama saying this just with weeks to go until the election. And yeah, I mean, the significance really is that this program, in his mind, has not been beneficial to not just Ghanaians on the ground there, but also conducive to a business environment that is enabling more foreign direct investment. So yes, he says that there are a number of measures that he would personally consider that he thinks could be more beneficial to stabilizing the macroeconomic environment, but also easing the burden for Ghanaians right now. If we take a look at sort of what has been done, a number of tax measures that you were just mentioning there has been able to support the Ghanaian economy, but we still have seen inflation quite high. I mean, it's upwards of 22%. That's come down from about 54% in December of 2022. And so, yes, it has eased up ever so slightly, but Mahama really is playing to the fact that Ghanaians are still struggling with their cost of living situation. And so potentially renegotiating this program with the IMF is something that could potentially help.
And what are his odds right now? He's the leader of the opposition party. How is the race shaping up ahead of the December elections?
Right. Well, so I think it's important to note there are these two leading candidates, which is the opposition party and the ruling party. There's 11 other candidates, but really the focus is on these two candidates. If we take a look at John's odds right now, we just actually looked. John has about 51.1% of the vote, and that's according to an Accra-based analytics firm. The ruling party candidate, though, Mahamadou Bawumia, has about 37.3% odds of winning. And again, I mean, the issue really for the ruling party is that they have this economic drag that's kind of been tagged to them. I mean, if we just link this back to something like what we're seeing in the U.S., I mean, a lot of voters are going to the polls with their economic cost of living conditions in mind. And so potentially then the opposition party is playing up on that. But we do have just under a month to go until this December 7th election. And we will see whether or not we do see the opposition party the opposition party being successful. We should note, though, Mahama is not new to politics. This is his third time running to be president. He has tried before in the past, not succeeded. And so potentially third time's the charm, unclear, but we're paying close attention to it, of course, as Ghana is one of the top economies here on the continent. That is a significant exporter, but also significant to the West African regional sector.
Well, if he takes a leaf out of Donald Trump's book, he'll just keep trying and maybe one day be successful. Bloomberg's chief Africa correspondent Jennifer Savazaja in Johannesburg. Thank you. All right, coming up, Spinneys reports its third quarter earnings. We speak to the CEO, Sunil Kumar, on the retailer's further plans for expansion. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Spinneys has reported profit for the third quarter of almost 40 million dirhams year on year. The Middle East food retailer says its 9-month revenue hit a record high of 2.3 billion dirhams, up 11.4% compared to the same period last year. Joining us now is the Spinneys CEO, Sunil Kumar. It sounds like everything is going on the right track. Strong growth on revenues, strong growth on profit as well. The profit also up 25% year on year. Just talk us through where some of these growth drivers have been coming from, sir.
Thank you, Jumana. We are in a very strong position. If you look at the last 9 months performance of Spinneys, we have grown almost 11.1% revenue growth from the like-for-like stores. And there are multiple factors for achieving it. Our unique positioning, which is the fresh food, it was on 60% last year, and now it has moved into a 63% participation. Likewise, our private label, which was 40% last year, now we have achieved almost 43% this year. And our capabilities of bringing internationally sourced products were well accepted by customers. And the other two factors, Jumana, for when I say the revenue growth, the two factors for a food retailer, it is important to see the transaction, which means the customers' growth within the store. We have got 27 million customers so far in 9 months, which has given us almost 10% growth, which I'm very happy with it. At the same time, normally when the customers' growth happens into any food retailers, normally the basket drops. But in our case, basket also has grown by 1 dirham upwards trend. So I'm very happy with the trend, Jumana.
Interesting. Yeah. Let me just drill down further to what you were saying about fresh food and private label and the growth that you're seeing there. Is this growth in volume or is it growth in price?
It is in both facts, because if you look at the last year, it was only 40% private label participation. What we are deliberately and consciously doing it, what is good for our customers in terms of value creation and without compromising the quality index. So we look at each and every categories where we can add more private label, where customers can see the value for each and every categories. That's what we are creating, and that's the reasons why you have seen a private label as well as a fresh food. We are adding more product range into a fresh food areas to ensure that we are understanding the ever-evolving food habits of customers, because food business is not an easy business, and it is something which we have to foresee what is happening for the years to come.
Yeah, let me just pick up on that and the fact that it is not an easy business. You obviously debuted your stock in May of this year with the IPO, and just taking a look at the stock price, it hasn't done a lot since May, despite the fact that your earnings are coming in very strong. What do you think investors are missing about the growth story here? Because as you've just articulated to me, all of the drivers are pointing in the right direction.
If you look at the Spinneys story, like I mentioned earlier, growth story is there. We have given a guidance for the next 5 years and what we can achieve within 5 years. And we are above what we have promised to achieve so far in 9 months. So the growth is there, prediction, and the bottom line, the efficiencies. If we are looking at our gross margin, if you're looking at the EBITDA margin, we have got almost 18.3% EBITDA margin, which you haven't seen any of the retailers, any of the competitions. If you look at it, we have achieved so far an 18.3. It is a highly industry in the retail industry what we have achieved. And if you look at the bottom line, despite the pre-tax, we have almost grown 27% in the net profit pre-tax. If I'm taking the after-tax, we grew 14.6%. So our efficiencies as a retailer to achieving the growth as well as in the bottom line is very strong. Unfortunately, the market conditions, I don't have any control. It has many factors, structural, market factors. So I can't do anything. My focus is only to achieve what is strategically we have to achieve for the coming next 5 years.
Yeah. Let's talk about the expansion plans. I know you opened your first store in Saudi Arabia. Just give us an update on how that's going and what more plans you have for the kingdom as well.
As I mentioned earlier, Saudi Arabia is one of the strategic country to be, because Spinneys as a brand, we have a wider aspiration to expand into GCC. And we opened our first store in Riyadh. And we are very happy with the performance of the store. The customers' feedback we got was remarkable, and we are very happy with it. And the second store we will be opening in December, King Abdullah Financial District. So we will be opening 2 stores, and we establish what we can achieve from the supply chain as well as the product mix, etc. So we are very happy so far with the Saudi expansion plan and the performance we have achieved.
Sir, that's a good place to leave it. Thank you so much for taking the time to speak with us today. Sunil Kumar, Spinneys CEO, thank you very much. Well, Nissan shares have tumbled to four-year lows after the company cuts its full-year operating income guidance by 70%. The Japanese automaker will cut 9,000 jobs and reduce manufacturing capacity by one-fifth. And this as it struggles to cope with tougher industry conditions. The ugly results are proving costly for the CEO Makoto Shida, who's forfeiting half his compensation starting this month. Well, coming up, Turkey's central bank governor is set to unveil new inflation forecasts. More on what to expect next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Turkey's central bank governor is set to unveil fresh inflation forecasts later today. That follows data signaling the almost 50% annual CPI rate is not slowing as quickly as officials hoped. Analysts are now widely doubting that interest rate cuts can actually begin this year. Bloomberg's managing editor for Middle East and North Africa, Honored Ant, joins us now. So here's the thing about these Turkish inflation numbers. They've dropped a little bit from where they were, but they're still sitting at around 49%. The central bank, as of now, still has a forecast of inflation hitting 14% by the end of 2025. Is that realistic? And should we expect him to be upgrading the forecast today?
Yeah, we probably should. As you said, those forecasts hardly appear to be realistic, especially for the next year. Even for this year, it doesn't look like Turkish inflation will come anywhere near 38%, which is where the Turkish Central Bank had said it would end the year. Now, these possible revisions to year-end inflation forecasts for this year and also for 2025 are extremely important for investors watching Turkish assets, because any revisions and anything else that Governor Karahan might say about the policy path ahead will obviously have an important impact. They will provide insight into the main question that everyone wants an answer to, and that is when the Turkish Central Bank will start cutting rates from its almost historic high level of 50%, where they have been kept since March. And by this time, everybody had expected the Turkish Central Bank would start cutting rates. But as you said, consumer inflation, the deceleration there has been much slower than expected. So it looks like the rate cuts will not begin before 2025. But whether or not that's really the case is going to be much clearer by the time Karahan speaks later today and provides insight into the policy path ahead.
Yeah, so the world has also changed this week and the last couple of days with the return of Trump, and that's going to have economic and political considerations. Maybe let's just start with the economic considerations. I was reading a report on our Bloomberg terminal earlier suggesting that the weakness in the euro and the weakness in European growth could actually pose another downside risk to the Turkish economy. This, of course, as we speak about the context of high interest rates. So it feels as though there could be a couple of growth headwinds to come for the Turkish economy in 2025.
That is true. The immediate knee-jerk reaction in euro-dollar cross was obviously something of importance, especially for Turkish exporters. I should remind you that most of the Turkish imports are in dollars, whereas the exports mainly go to the European Union, which is the largest destination for Turkish shipments abroad. So any movements there and dollar strength obviously is a great headwind for Turkish exporters, and it adds to the already larger challenges that we've been seeing, which is, as you said, the weakness in growth in Europe. Economic activity and strength is always a bigger factor in the strength of Turkish exports to the continent, as opposed to the currency competitiveness, so to speak.
Yeah. And Anwar, what are people saying about how the relationship between President Erdogan and President Trump is going to look like? It's been a bit of a testy relationship with the U.S. Things were looking up when Sweden joined NATO and Turkey stopped blocking it. But things have also deteriorated over the summer due to the ongoing war in Gaza. How can things change under a Trump presidency now?
The general consensus is that both Trump and Erdogan have a personal rapport. They like each other. They work good with each other, which is true. But one should also remember that some of the biggest crises in Turkish-U.S. relationships in recent decades actually took place during the Trump era, the first Trump era, including a major currency crisis in Turkey that was, at least arguably, partly triggered by a diplomatic crisis between Turkey and the U.S. At the time, even Donald Trump was threatening economic destruction for Turkey on his Twitter feed. So it's not as smooth as people would like to believe, but on the other hand, the two have managed to work out important differences, and going forward, I think the expectation is that relationship would improve, especially in the areas of economic collaboration as well as in foreign policy areas where the US and Turkey have very large differences, especially in areas like Syria. The U.S. support for Kurdish militant forces there have been a big issue for Turkey, a national security threat, and that's been a major factor of deterioration in the relationship. And we do expect a certain amount of improvement there. Yeah. But when exactly it's going to happen, obviously it's going to depend a lot on what Trump does after he takes office.
Yeah. Bloomberg's honor and managing editor for Middle East and North Africa, thank you very much. A quick look at futures. That is it for our first hour of Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Stay with us for the second hour as Jennifer Zabazaja joins me from Johannesburg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Asian stocks catching a tailwind from the U.S. as the post-election rally gets a boost as the Fed cuts rates for a second straight meeting. Donald Trump names Susie Wiles his White House chief of staff as the world waits to see who the president-elect may tap to drive his economic agenda. Plus, Nissan stalls. Shares tumble to a 4-year low after the automaker cuts its profit outlook and slashes 9,000 jobs. Well, good morning again. It has just gone 9 a.m. across the Emirates. I'm Jumana Versace in Dubai.
And I'm Jennifer Zabasaja in Johannesburg, where it is just gone 7 a.m. Welcome to the second hour of Horizons Middle East and Africa. And it's also Friday, of course, Jumana. We made it. It was a busy week.
Quite a busy week, to say the least. So much going on in these markets with the U.S. elections to get through, the Fed, Bank of England meeting, and also that ongoing NPC meeting in China. So watch out for some of the headlines coming out of that potential China stimulus package later today. As for markets, Wall Street ended at an all-time high. S&P, NASDAQ once again reaching record high in trade yesterday. This as the market digested the Fed 25 basis point cut, but also the signaling ahead, the Fed chair being slightly more cautious about the path for forward interest rate cuts. So the market has priced out some of the interest rate cuts for 2025. 10-year yields, we had a massive backup in yields once it became apparent that President Trump was going to get reelected. But in the past 24 hours, we've actually come down again. We've rallied about 10, 11 basis points. Some people seeing this level in interest rates as a buying opportunity. Brent also stabilizing today, coming off a little bit, down 0.6%, but $75 seems to be sort of a support level for oil here. Remember, we bounced at the beginning of the week on geopolitical concerns and the OPEC Plus decision to push back oil barrels to the market by a month. So that has given somewhat of a boost to the energy complex this week. Today, not doing that much. And then the pound also in focus. Yesterday, we had the Bank of England meeting as well, buried under all of the other news, but they did cut 25 basis points, but we're very cautious about the path ahead. Similar to the U.S., where also we saw cautiousness prevail with the Fed's commentary yesterday too, with the Fed Chair Jerome Powell not really committing to another interest rate cut this year as well. 3 cuts priced in for 2025, 78 basis points cumulative. That was sitting at more than 160 just a couple of weeks ago. All right, let's also check in on how markets in Asia are faring. Avril is in our Singapore studio. Avril, just give us an update on how these Asian markets are faring right now.
Yeah, we've seen Asia stock gauge pull away from session highs. The drag is really coming from China. The focus is on the NPC. And of course, traders had, for the most part, been betting on this big boost in the form of Chinese fiscal stimulus potential announcements amid the looming threat of Trump's tariffs. And back from the lunch break, we're seeing China's stock benchmark managing to pair some of the declines of about 7/8% earlier. But note here that we did actually see it managing to clock gains of 1.3% earlier on in the session. So this gives you a sense of how caution is coming through perhaps traders bracing for disappointment on the offshore yuan as well. That weakness sitting above 716 against the greenback on a day where most Asia currencies are actually gaining ground against the dollar. Jumana.
Avril, thank you so much. Avril Hong in Singapore. Now, the Fed has cut its benchmark rate by 1/4 percentage point in a unanimous decision. The chair, Jay Powell, declined to say whether they will cut rates again in December, but he also says the election outcome will not affect what policymakers do in the near term.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Well, Bloomberg executive editor for Asian markets, Paul Dobson, joins us now. I was just articulating earlier that the Fed chair is in a very difficult position now, especially with all of those questions from the journalists. But on the decision itself, they cut interest rates by 25 basis points. That wasn't a surprise to markets, but perhaps what was a surprise is he is leaning towards being data dependent again and not really committing to another interest rate cut in December.
Yeah, I think that's generally right. The market expectation for this meeting in a broad sense was pretty low. We were priced, and the analyst consensus was for the Fed to just, push through with a 25 basis point cut and have no fireworks and don't change the narrative too much because, there's other stuff going on in the background to do with the election. And that's exactly what we got. So there wasn't very much of a guide either way on what we might see in December. Continue to follow the data. The market is priced for about 70% worth of a 25 basis point cut, i.e. 2/3 likely to happen, 1/3, maybe not. So there's a little bit of caution there. But at the moment, the Fed does seem to be on that slowly cutting interest rates path. And I think the other thing that Powell said that might be worth paying a little bit of attention to is that right now, the Fed isn't paying attention to what Trump might do when he comes into power. You don't need to second guess them. He's not going to be taking the reins until January. The Fed shouldn't really kind of try to second guess what that policy could be ahead of time. So for that, at least, the politics doesn't come into play. So it's back to the data, keep an eye on inflation, keep an eye on labor markets.
Yeah, Paul, let's just stick on that. I mean, what are you interpreting from Jay Powell's comments on the state of the U.S. economy in particular? Because if he is planning on being data dependent, this is important where this U.S. economy stands at this point.
Yeah, quite a little to take away, I think, again, from this particular meeting. I think that we know that the Fed overall is still a little bit concerned, some policymakers more than others, on how sticky that inflation is. The most recent data has kind of given a little bit more fuel to that argument. But at the same time, we also know that there's a little bit of concern about how quickly the labour market is deteriorating. And we've had very mixed data. What we weren't helped with at all was the non-farm payrolls data earlier in this month, which had that extremely low number that people kind of dismissed as being just too unreliable because of the impact of the hurricanes and so on and so forth. And so we're in a little bit of limbo at the moment, just waiting to see kind of where we go from here in terms of that strength. Company earnings have also been a little bit mixed, a lot of positivity out there, but not unanimously so. So there's a little bit of a question mark there, and that's probably why, markets are a little bit uncertain in their pricing for the Fed at the moment.
We'll leave it there. Bloomberg executive editor for Asian markets, Paul Dobson. Paul, thanks so much for that update there. Let's pivot back to the U.S. The U.S. House race has taken on increased importance after Republicans not only won control of the White House, but also the Senate, claiming all three would give the GOP powerful leverage in high-stakes tax and spending battles next year. Meanwhile, Trump's new administration is already taking shape, the president-elect naming Susie Wiles as his White House chief of staff. For more, let's bring in Bloomberg's Vonnie Quinn, who's joining us now from New York. So, Vonnie, this transition is seeming a lot different than the last time around we saw Trump heading to the White House. I mean, give us a sense of how you're reading into it.
For sure. Last time around, it was chaos, right, Jen? It was very, very different. This time around, partially thanks to that woman, Susie Wiles, who Trump called the Ice Maiden when he was accepting basically the election, saying thank you to his supporters. It's partially thanks to her. Now, she's been in politics way back since 1990, since Ronald Reagan's first attempt to become president, which was successful. And she has been credited with keeping Trump on message and also keeping some kind of law and order, if you like, around him, which is difficult to do because, as we know from his first term, it does tend to attract chaos and to emanate chaos. So she is now his chief of staff. She's the first female chief of staff that Washington has ever seen. You also mentioned the House races. I just want to update you. There's still about 24 to be called, but it is leaning in the Republicans' favor. And that's important because if they get to 218, then it would be all three branches of government GOP. And that would make Donald Trump's nominations basically shoo-ins. So he has about 4,000 positions to fill, including a couple of dozen or more cabinet positions. And if there were to be no opposition in the Senate or the House, then obviously they would just be shoo-ins.
Bonnie, we've got quite a handy terminal page, the elect page, ELEC, that I've been using quite a lot. And I've noticed that just in the last 24 hours, we've switched it now. And we've got a whole prediction market page about who is going to be in some of these key cabinet positions. So just give us a flavor for what the expectations are vis-a-vis who could be the Treasury Secretary, obviously very important role, and then the Secretary of State as well.
Right. I don't think we thought we were going to be here already on just literally the Thursday of election week, but here we are. There are names being bandied about and being talked about at Mar-a-Lago, according to sources. So in terms of Treasury Secretary, it's possible Stephen Mnuchin might make a comeback. He was one of the only people that lasted the full term, the full 4 years in the first Trump administration. Robert Lighthizer is another name that's being bandied around, U.S. Trade Representative in the first term as well. He was the architect of the adversarial position on China, so that might make investors a little wary. He may go to commerce instead. Howard Lutnick is somebody else who is being bandied around. He was campaign chair. But the thing with Howard Lutnick is he would have to give up his assets unless he were to do something such as becoming one of these special advisors or what have you, where you can work for 130 days and you don't get paid, but you also don't have to give up anything. As for Secretary of State, names being floated around include Rick Grenell. He's another fierce loyalist. He served as acting National Intelligence Chief the first time round. And we also have Senator Marco Rubio, of all people, who, of course, was a contender last time around, and Donald Trump beat him.
Yeah, and they had their own war of words for a little bit. But, of course, we did see him out on the campaign trail for Donald Trump. So interesting insight there. Bloomberg's Vonnie Quinn in New York for us. Vonnie, thanks so much for joining us. Now coming up, Nissan slides after a profit warning and job cuts. We'll get the details next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Nissan has tumbled to 4-year lows after cutting its full-year operating income guidance by 70%. The Japanese automaker is to cut 9,000 jobs and reduce manufacturing capacity by 1/5 as it struggles to cope with tougher industry conditions. For more, we are joined by Danny Lee, our Asia transport reporter. Danny, sharp reaction, adverse reaction. The stock today, it's down more than 6%, but this has been a theme that's been ongoing the last couple of years. Tell us more about the troubles facing Nissan at this point.
Yeah, Nissan tells a story of what all global automakers are really facing around the world. First, we've had the likes of Volkswagen, we've had Stellantis, and now Nissan, which is sending this warning of its impending crisis, this massive restructuring it has to undertake in order to right the ship. Clearly, one of the big struggles is this sales slump that they're facing in key markets such as China and in the United States. But then for Nissan, on top of that, it has these internal struggles with relation to its having a workforce that is making too few cars and this excess capacity. So this restructuring, by and large, is there to try and right this ship, and the extent to which it's having to do so by cutting manufacturing output by 1/5, and then having to also say that they're not going to be making as much money as they thought they would. And again, this is the second time it's had to reduce its guidance on full-year operating income. So the struggles for Nissan, which is Japan's third largest automaker, really tells the story of how pretty much every legacy automaker out there is struggling, particularly against the Chinese automakers who are emerging.
How, Danny, I mean, I wonder if we think about just internally for the CEO. I mean, he talked a little bit about what this could potentially mean internally for people like himself and others within the company. I mean, what more are you reading from the comments that he gave after we got this notification?
Well, it does send a very strong signal when the CEO is cutting his pay by like 50%. And, it's going to take a lot of leadership from the front in tough decisions and in setting about the kind of strategy they're going to have to set forth, particularly around how they adapt to EV sales and the kind of products they can offer. Because Nissan particularly is fallen behind on some of its product offering and missed out on sales, where in the US there's a bigger preference towards hybrid cars. So clearly for Nissan, which has gone through a lot of ups and downs over the many years, particularly after the saga of Carlos Ghosn, it's really going to have to try and right this ship, and this is just part of an ongoing plan here.
Yeah, struggling environment for automakers. Thanks so much, Danny Lee, our Asia transport reporter there in Hong Kong for us. Now, still ahead, we'll get the market outlook with the Vontobel CIO as investors shift their focus from the Fed now to China. Stick with us. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. Asian stocks are extending Wall Street's rally today after the Fed cut interest rates. Investors now shifting focus to China, which is set to unveil a fiscal package worth trillions of yuan that could help offset the impact of potential trade tariffs under President-elect Trump. Joining us now is Dan Scott, the head of Multi Asset and CIO at Vontobel. Dan, good to speak to you again. What a week it has been for markets. It certainly does feel as though we're seeing a sea change in terms of the market narrative as well. And a month ago, perhaps the market had fully focused on this interest rate cutting profile that was to come out of the Fed, the emphasis on the weakness in the labor market. Now we're once again back to the paradigm of talking about inflationary shocks, about tariffs, about protectionism. How do you think that is all getting factored in to the markets at this point? And is it adequately being factored in?
Well, I think the one thing that no one really was contemplating, or fully through at least, was that you would have a clean sweep, that you would have a complete control of Congress, and that really gives Trump a strong mandate to push through whatever it is he wants. And so we're now not, considering a phasing out of the Trump-era tax cuts. In fact, it's more that we're considering that, they're likely going to be even further tax cuts, that maybe the corporate tax rate could come down to 15%. That, in addition with stimulative measures like deregulation on banks and other stimulative measures that he could be pushing through, puts us in a place where we're looking at a U.S. economy that's potentially in liftoff mode here rather than in soft landing mode. And at the same time, on the other side of the world, you have the world's second largest economy that's also looking to unleash some more meaningful stimulus to the market. So now you have the two largest economies in the world working with stimulus, and all of a sudden that means that we're likely going to be in a very risk-positive environment for assets.
And we're seeing that a bit, Dan, if you just take a look at global equities. But I mean, we were talking about how close the S&P is now to 6,000. I mean, if we're in this liftoff mode for equities at this point in time, is there a positioning for a pullback? I mean, is it inevitable that we could experience a pullback, at least when it comes to equities, and just how elevated we're seeing valuations at this point in time?
Yeah, so exactly. It's all a question of valuations, right? I mean, the multiples, the P and it's the E. And so if your expectations on earnings are going higher, then all of a sudden the multiple's not that stretched. And I think that's what the market's telling us, is that It's saying, look at the third quarter. Actually, we had a good beat ratio in the U.S. We had a good earnings season globally. Margins were actually, fine. They didn't expand much further, but they remained high. And earnings growth was actually intact. So now looking forward with a view on potential tax cuts, you could actually see a multiple expansion rather than a contraction on top of that, positive environment for increased consumer confidence and spending on the back of tax cuts and other stimulative measures. So I think that's why, short term at least, this all looks very positive for risk assets. Longer term, it's not at all so clear because, you have to consider that there is going to be a debt burden here. And until we have the granularity on the policy, we need to understand exactly how tax cuts could be funded. It's the debt burden in the U.S., of course, is in absolute terms not an issue, but it is an issue if it's not funded through incoming receipts, through economic growth or other sources, spending cuts. And that's something to keep in mind because it's going to have an impact on bond yields.
Yeah. So, Dan, you talk about the economy potentially going into takeoff mode. So that is good for growth. But then you also talk about the size of the fiscal deficit in years to come, which would be dollar negative. So how do you square the two up together? One of the big Trump trades has been playing for further strength in the USD. But if we start seeing those headwinds on the deficit, is that sustainable?
Yeah. I think one needs to be positioned carefully here. And actually, I think that the recent dollar strength is maybe somewhat exaggerated and that there is potential for some catch up for emerging market currencies versus the dollar, as well as the euro versus the dollar. So right now, short term, the market's playing the rates differential, and that's why the dollar has strengthened somewhat. But I think that it's very clear. We've had the message from Powell. We had the first 75 basis points now from the Fed. Rates are likely going to continue lower, and they need to go lower because inflation has come down, and that means that real rates are still higher than they need to be. And if you look at the underlying strain, especially for the lower income segment of the consumers, then with credit card delinquencies, auto loan delinquencies, other areas of strain, then it's clear that interest rates do still need to come lower somewhat in order to cushion that blow. So there's the outlook for risk assets on the one side, and there's what's happening in the actual economy on the other. And that's why we think rates are going to come lower and the dollar is going to weaken. And it's another reason why actually we're holding on to our overweight gold position.
Well, so, Dan, just on that, where else are you looking to if you think that risk assets potentially have some room to play catch up?
Yeah, so I think you need to be clever now in how you allocate to equities, because you brought it up yourself, the topic of valuations, and there where equities look expensive is actually mainly around the remaining Mag 7 that still, have high valuations and have high growth. Their valuations, I think, could have a bit of a mean reversion where you see a slowing down in returns and contribution of returns to the index among the Mag 7 and a catch up of the 493. That's what we would be doing right now. We would be rather looking at the 493 than the Mag 7. Other areas, of course, that are direct beneficiaries of Trump policy, like financials, for example, or the energy sector, would potentially also be areas where you'd look for maybe some opportunities. What we don't necessarily agree with is how the market's been bidding up small caps, because again, even though we had another 25 basis point cuts, rates are still high. And keep in mind that something like 45% of the Russell is not profit making. And those that are levered, those are the rate sensitive. Yeah. They're still under strain. So rates need to come down quicker for us to be really confident that small caps could have a catch up.
Yeah, that is interesting because the day after the elections, the Russell was up something like 6%. But as you say, it's still very rate sensitive. So if they keep rates higher for longer, not so great. Dan, lovely to chat to you. Dan Scott, CIO at Vontobel Multi Asset Management. Quick look at futures before we head to the break. Coming up, we're going to be talking about the Bank of England Governor Andrew Bailey, who has spoken to Bloomberg after they cut rates. More from that interview next. This is Bloomberg.
This is Horizons Middle East and Africa, our top stories this morning. Asian stocks catching a tailwind from the U.S. as the post-election rally gets a boost as the Fed cuts rates for a second straight meeting. Donald Trump names Susie Wiles his White House chief of staff as the world awaits to see who the president-elect may tap to drive his economic agenda. Plus, Ghana's opposition leader tells us why he would renegotiate the country's IMF program if he wins the upcoming elections. It has just gone at 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg.
And I'm Joanna Versace in Dubai, where it has just gone 9:30 a.m. Welcome to the second hour of Horizons Middle East and Africa. And of course, we have been monitoring so many different events throughout the course of this week, the main one being the U.S. elections. Just to let you know that the state of Nevada has just been called for Trump as well. At this point, just a formality since he already has the electoral college votes and as we know, is on track to be the next U.S. president. But now also networks are saying that President-elect Trump has also taken the state of Nevada. Jen.
Yeah, been interesting to really watch how the states are playing out. But Jumana, let's take a look at where markets are positioned ahead of the trading day. As you mentioned, it has been a busy week, to say the least. We had the U.S. election. We did have central bank decisions. And if we take a look at U.S. equities right now, they aren't doing too much, but definitely experiencing a little bit of a pause, a breather after what has been a pretty busy week for U.S. equities. So S&P futures and NASDAQ 100 futures looking like a stronger open. What we did see on Thursday, the S&P did hit that 6,000. It's right now at 6,000 and notching its 49th record this year. The NASDAQ also closing Thursday above 1.5%, setting a fresh peak. Also paying close attention to the 10-year yield. We talked about the central bank decision that we got from the Federal Reserve, potentially a more dovish Powell, but we did see Treasury yields declining across the curve right now at just about 4.3335, and Brent crude pulling back then ever so slightly, about 0.5%. Brent crude right now at $75.26 a handle. Let's turn, though, to how markets in Asia are faring. Avril Hong is standing by in our Singapore studio. Hey, Avril.
Hey, Jen. Yeah, we're seeing that focus really on China's NPC. What traders want to see is details on housing support, on how local governments can maybe be helped to ease their debt burdens, the details, the fiscal stimulus surrounding support for the Chinese economy. And ahead of that readout from China's NPC later today, you're seeing how Asia's stock gauge has pulled away from session highs, and we're seeing negativity on the Chinese equity as well. Now, I also wanted to flag what's at stake because Chinese stocks have been, for the most part, outperforming India and Japan equities. And of course, the underlying narrative is that the potential for Trump tariffs is causing traders to bet that we're actually going to see Chinese authorities come through. So keep that in mind. That's what is at stake as we look ahead to events of later today out of China. Jen.
Avril, thank you so much for the overview of what to expect. Now, speaking of, emerging market assets have risen after the Fed's rate cuts. Both equities and currencies have rebounded from the slump in reaction to Donald Trump's win. And for more on how the red sweep in the U.S. impacts EM, we're joined by Luis Costa, the head of emerging market strategy at Citi. So great to see you, Luis. I've got to say, I've been a little bit surprised to see the reaction in EM assets since it became apparent that President Trump is returning, Trump 2.0. We've seen a rally in assets and also a tightening of spreads. What do you point that down to?
It is very surprising, and I think that there is a lot of maturity in the way EM assets responded to the U.S. election result. In a way, the markets are doing the following: the markets are moving the dollar range higher, so there are expectations of a more volatile, more lively dollar, let's say, and markets are also moving the range of U.S. rates, especially when it comes to back end, given the fiscal narrative. But as we said before, there is no reason whatsoever to back away from EM. Some EM central banks will continue to ease. some endogenous growth aspects, they will continue to dominate. It's the case of, exceptional growth in Brazil, exceptional growth in South Africa, so good for equities. And obviously, on the currency side, that's where we believe that it might be a little bit more volatile.
Dig into that a bit more, Luis, because you mentioned Brazil, you mentioned South Africa. We have seen some green shoots, in particular here in South Africa. Is there anywhere else that you think potentially we should be paying close attention to?
Well, I mean, the asset class is very well shielded. Let's be honest here. I mean, from the current account perspective, EM gained current account shield. So, I mean, the performance of the current account over the past 5-6 years has been a little bit better. The fiscal is something that is not only in the US. The fiscal dominance is something that we should be definitely monitoring in emerging markets. But we do like many spaces. We do like to receive rates and buy bonds in Central Europe. I think South Africa is a very interesting case where you've got this Goldilocks situation where you can buy bonds, but you still bullish growth. Brazil is also very interesting, as we mentioned before. Mexico will be a very interesting nervous case. I mean, we've been backing away from Mexican risk. Colombia continues to be a very interesting case to own bonds as well, watching the fiscal performance. So there are quite a few interesting opportunities there. And we do believe that, I mean, taking a step back, in this environment where the FX can be a little bit more volatile, we prefer to be on the credit side. We prefer to buy EM-denominated bonds, dollar bonds, rather than EM local currency bonds. But even in the local currency bonds, we do believe that there will be scope for alpha generation here.
Yeah. Luis, Jennifer and I were saying that we're really happy we got to the end of this week because it's been quite a week, but there's still more data to come and more potential stimulus measures coming out of China tonight. How much of a swing factor for EM markets is China's stimulus package or potential stimulus package going to be in the near term?
We believe this is a very tricky assumption the markets are making now. Markets are believing that, okay, if it's a Trump outcome, most likely Chinese regulators will be even more aggressive, and the numbers and the timing of the fiscal stimulus will be more market friendly. This is an assumption that we've been very careful. We believe that the numbers or the nominal numbers in trillions will be significant. I don't think there is any doubt about it. We agree with that, but we also worry about the phasing, the timing, and the deployment of this fiscal stimulus. And that's where the markets might get a little bit more on the cautious side. I think that's, expectations are a little bit too bullish. So we do believe there's a fiscal stimulus coming. We do believe that the anatomy will be very different from the one seen in the 2000s, will be more endogenous, will be more about domestic growth. But all in all, I think this is definitely positive news for Asian stocks.
How does this play into oil prices, though, Luis? Because, we talk about China demand, of course, being a part of this narrative. Just earlier this week, I was with a number of African oil ministers who are looking to ramp up production. So I wonder, how you think then this could potentially impact the price that we do see with Brent.
That's a very interesting point, and we've been discussing this quite a lot, within our strategy team at Citi. Because if you take Trump, let's put Trump on the side, right? The projections of global growth and global supply of oil going into 2025, they were bearish oil. Our commodity research team expects something around 60 or 65. Over the next 9 to 12 months. So the projections are bearish. If you put Trump inside the picture now, it probably gets worse, right? You remember 2016, the drill, baby drill, and Trump economic policy is pro increase of oil supply. So, and which is something that is already happening from the States anyway. So we find it very difficult, other than the geopolitical premium, which is something that it's in there, maybe $7, $8, $9 of geopolitical premium in the oil price now. We think that there's a downside. The question is, how much are we going to go down in dollar? And this is bad news for the oily credits out there, especially the oily credits in Africa.
The oily credits. That's a new term. Is that a technical term, Louis?
It is.
Thank you so much. It was great to have you with us on the show. Louis Costa, head of emerging market strategy at Citi. Well, Bank of England Governor Andrew Bailey says he discussed market reaction with the Chancellor Rachel Reeves before and after the recent budget announcement that rattled investors. He spoke to Bloomberg after the Bank of England cut interest rates by a quarter point to 4.75%.
There are a lot of uncertainties out there, both in the world and there's domestic uncertainties as well. So we've emphasised the word gradual again because we're going to have to take account of how those uncertainties play through. I'm not really in a position, I'm not as any of us are in a position to say, well, gradual means every so often. That is not a judgment that we make.
But it's a judgment that the markets are making. So if you take away any major shocks, does it seem right?
Well, I think the markets have made that judgment. I think it's a reasonable reflection of the forecast that we've published today, by the way, but which is, by the way, conditioned on the market curve. So it's a reasonable sort of reflection of that judgment that we think inflation is going to come back to target sustainably within the sort of horizon that we look at.
Governor, the Chancellor said she spoke to you at the IMF, also about the budget and some of the things that were coming up. Did you warn her of market volatility or what the market would do?
Well, we talked at the IMF about, I think the Chancellor said, we talked about the IMF about her evolving thinking about the budget and her evolving thinking about the fiscal rules. We have, by the way, we have a very regular dialogue. I'm on my 6th Chancellor since I was appointed, 5th since I started, and with all of them, we have a very regular dialogue. So Chancellor and I do that. So we talked in Washington about her evolving thinking about the budget, about the fiscal rules, and I think the Chancellor said, we talked last week about markets. She asked me for my assessment of markets. As the Bank of England is, we provide the Treasury with our assessment because it's obviously something that we're very close to. I'm very, very open and willing to provide that assessment. So yes, we talked through the assessment of markets.
So, but this was before the event. So was the market reaction expected on your side?
Well, both before and during, actually. So look, I think that if you go back to the beginning of last week, our assessment of sterling rates markets was that at the shorter end they were sort of positioned long for interest rates to go down further than was expected. I think that obviously changed during the week. It wasn't surprising to me, therefore, that there was a closing out of positions, probably stop orders were being hit. That closing out needed to take place. I think it took place in an orderly fashion. We weren't seeing disorder in the markets. And by the way, I think by Friday afternoon post non-farm payrolls, the dominating event in markets was expectation of the US election, not the UK budget.
Do you think the Chancellor was expecting markets to behave that way?
Well, I think this was obviously a big budget, as the Chancellor herself said. So I think it's reasonable to expect that markets will respond to it. I mean, they knew some things. They didn't know, they didn't know the precise form of it until it was delivered by the Chancellor in Parliament. So I think it was entirely appropriate to have some reaction in markets. But the point is, it's been an orderly reaction. Markets move. We should expect markets to move. It's only when they become disorderly that we should, be concerned in that sense.
Governor, I know you're very reluctant to talk, what possible trade wars or tariffs from the U.S. would look like on the economy, but would they be inflationary or would they reduce growth?
Well, I mean, we don't know the answer to that question. I think, what I will say is, look, the UK is a very open economy. So obviously this area matters. The Chancellor has said yesterday and today, quite rightly, and I will join her in this, that she will make the case for open markets and free trade. And I will strongly support her in this because I'm a very strong supporter of free trade. I think you would expect the UK to do that. We have a very proud history of free trade in this country. We will no doubt, say our piece and make our case. But we'll see. I think it's important just to say, look, let the new US administration get into office. We will work with them. I've worked with a lot of US administrators over my career. We will work with the next US administration just as we do with the current one, and we did with the previous Trump administration, by the way. I expect constructive relations, and we will have a good dialogue.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zapasaja in Johannesburg. European leaders meeting in Budapest are exploring ways to finance their militaries and clean technologies. Donald Trump's return to the White House has accelerated efforts to boost the continent's own defense capabilities and to make its industries more competitive. For more, let's bring in Bloomberg's Oliver Crook, who's joining us from Budapest, still in the football stadium. So, Oliver, I mean, Trump's return already having an impact with the bloc. Take us through it.
Yeah, absolutely. And listen, last night was the first opportunity for all these leaders to get together. They had this big dinner here in Budapest, and it was their first time where they officially were discussing Donald Trump's presidency. And of course, everybody who was here, every journalist was asking everybody, including myself, as they were walking in the interviews we had, what are you expecting from Donald Trump? What should Europe's response be, particularly on Ukraine? And I had a chance to speak with the Danish Prime Minister yesterday, Mette Frederiksen, literally moments after she got off the phone with Donald Trump to congratulate him. Have a listen about what their conversation was focused on.
We had a long discussion about some of the topics that are a big concern for US and for Europe. Of course, the war in Europe, Ukraine, the closer cooperation between Iran, North Korea, Russia, and unfortunately also China.
And she said she was reassured by the fact that Trump seems to be spending a lot of time now in the last couple days on outreach and speaking to other leaders around the world. She said that she also saw that there was really no sense of schism fundamentally between the EU and the United States, but there's still a lot that we don't know. And she made that point very clear. The other point that everybody has been making as they arrived here is that basically the Ukraine question is non-negotiable. Having said that, I also spoke to Viktor Orban's chief advisor and asked him about were they drinking champagne on the eve of the election in the United States. He said yes, and he says that this is going to force Europe to have a different approach in terms of the war in Ukraine. And the question is, as we get out of here, and we will have this morning, as Europeans file in after that dinner last night, maybe a more unified message from the European leaders in terms of what their approach should be towards Donald Trump.
Yeah, well, we thought the U.S. elections was going to be the main political event of the week, but once again, Europe are stealing the limelight. A German political crisis potentially in the making. I'm seeing that the German Chancellor Olaf Scholz is actually still attending this summit. How much is the backdrop domestic turmoil in Germany likely to weigh on how responsive he is to the bloc's reactions and thinking about how they're going to be reacting to a Trump return?
Yeah, Jumana, this is absolutely fundamental. And this was a question we asked to a lot of leaders as they came in yesterday. And I think that there is a real consciousness within Europe that you can't really get things done on a major level without a strong France and a strong Germany. You have now a fairly weak France. Emmanuel Macron's mandate is not what it used to be. And of course, now you have a German government that has basically collapsed. Olaf Scholz, as a consequence of that, arrived here late yesterday. So he missed a lot of the sessions yesterday. And it's a sort of damned if you do, damned if you don't. Olaf Scholz can't not come here because you can't not have Germany at these meetings, but he's also not in a position to do a very great deal. We're expecting to hear from him over the next couple of hours, but yet again, this is the day where we're supposed to be focused on the Draghi report, a more unified Europe, a sort of Europe first approach, if that is what they're up against in the United States, and that is going to be very difficult to achieve without a strong German government, and that is just not what we have.
Great reporting as always. Bloomberg's Oliver Crook in Budapest for us. Oliver, thanks so much for joining us. Now, coming up, we come back to the African region. Ghana's opposition leader wants to renegotiate the country's IMF program if he wins the upcoming elections. We hear from John Mahama next. This is Bloomberg.
We're not party to the debt renegotiation, and we're also not party to the IMF program. But happily, we've had the opportunity on my request to meet the country director of the IMF, and he's briefed us, quite largely on a lot of what the two agreements entail, the IMF one and the debt agreements. We've not yet seen the final details of the debt with the commercial creditors, but we've looked at some of them, and we've done our own analysis of how the repayment schedule is supposed to be. We're supposed to end at about 55 to 58% by 2028.
Yes.
But if you look at it in our own analysis, if you draw the graph, we have two major humps. One in 2026, where a big chunk of the domestic debt is supposed to be paid. I think it's about 182 billion cedis. And if you consider that Ghana's total budget is just about 200 billion, then it means that there's going to be a hump there, and we need to see how to deal with it. Then the next hump is just before 2028, where there's a big payment in terms of commercial debt. And so we need to look at how we can refinance some of these so that we can smoothen out the trajectory of the debt repayments. And so those are things we would want to engage the IMF very early when we win, to engage them very early to see how we can work together, to make sure that we're able to maintain debt sustainability. We want to reintroduce the sinking fund, and we want to work on increasing our energy, oil and gas production. Over the last 8 years, Ghana has not been a very friendly environment to upstream producers, and so we'll try and get as many of them to come back as possible and give them the incentives that are required for them to ramp up in terms of gas and oil production.
That was John Mahama, leader of Ghana's National Democratic Congress, speaking with Bloomberg. Let's bring in our West Africa Bureau Chief, Moses Mozart Jawo, who is joining us now. So, Moses, just give us a sense of how things are shaping up ahead of this election, which is just a few weeks away.
Thank you very much, Jennifer. So the polls are exactly a month away, and they seem to look set. The Electoral Commission recently said it has started printing the ballot sheets after verifying and approving 13 presidential aspirants for the contest. This includes the main candidates, the Vice President Mahamudu Bawumia, and of course the main opposition candidate, John Dramani Mahama of the National Democratic Congress. 7 other parties and 4 independent candidates constitute the rest of the list. In September, the main opposition party led a protest to demand forensic audits of the voter roll, with allegations that the voter register has been bloated by some 24,000 names that shouldn't have been on the register. It seems that that issue has been resolved now, as we haven't heard anything about that in recent weeks. At this time, too, we see the political parties implementing their most strategic campaigns, so you tend to come across very interesting jingles on radio, TV, and social media, especially the 2 main political parties trying to tease at each other and punching holes in each other's proposed policies and manifesto promises. So interesting days ahead as we look to December 7th.
Absolutely. Absolutely. Bloomberg's West Africa Bureau Chief, Moses Mozart Jawo, thanks so much. I'm Jennifer Zabasaja with Jumana Bersechi there in Dubai. Daybreak Europe is up next.